Apollo, when will the Fed stop raising interest rates, and what does that really mean for investors?
And that's a really big topic right now. And to understand and get a perspective on that, I think it's useful to go back to the last time that we had high inflation in the US. And that actually was in the early 1970s when we had a confluence of big events. We moved from the gold standard to the type of money we have today. We had the OPEC energy oil crisis. We also had a big drought. So prices went up. And at the time, the Fed actually raised rates, inflation came down, but the economy slowed down as well. So at that point, it actually, the Fed reversed course, cut rates, and the economy rebounded, but inflation expectations stayed high. In other words, people expected inflation to stay high, and that created a self-fulfilling prophecy. Because if you're a union negotiating a contract, well, you're going to bake in a high expectation of inflation. So we had high inflation for the whole decade of the 70s until a Fed chairman by the name of Paul Volcker came along, and he said, we're going to stick with high rates because it is more damaging to have this high expectation of inflation than to have a relatively, a lengthy or maybe not as lengthy economic downturn. So basically what he suggested is that instead of moving up and down on rates, let's stick with high rates and reassure markets, reassure investors and consumers and businesses that the Fed is serious about fighting rates. And that's what he did in the late 70s, early 80s. We did have a recession in the early 80s. But what came afterwards, Greg, were 40 years of price stability and incredibly low inflation because everybody had the conviction that the Fed will take care of inflation should it come up. And last year, as inflation came up, Fed kind of looked at the 70s, my guess is they realized, okay, so we have a choice now. We can raise rates and we can keep raising rates to send that clear message, because inflation is not just about supply and demand. There's also a human behavior element that is through the expectations that people have. And the Fed basically decided we're going to stick to this policy until we do see inflation coming down and until expectations of inflations will come down from where they are. So where are we today? Well, it seems like that the Fed has been raising rates for a while, and that has caused inflation to some degree. One of the reasons that inflation is going down is the Fed raising rates, and we had a high of about 8.5% or so. It's been coming down ever since for the past few months. Just recently, it went down from about 5% to even below 5%. But what's interesting, Greg, is the Fed will likely stop raising interest rates when it is reassured that the expectations of inflations are pretty much in line with the long-term average, about 3%, Fed's target being about 2%. So where are we today? Well, it seems that inflation right now, if you look at a market metric called the 5-year break-even inflation rate, which really looks at the expectation of inflation on average over the next 5 years, derived from different types of bonds, it is actually quite interesting, because what you see is that as of today, and today we happen to be on what day is today? Is the it's mid-May. It's today's the 11th, so this is May 10th. It seems that the inflation right now expectation on average over the next 5 years is about 2.13%, which is certainly in line with the Fed's target of about 2%. So it is quite possible that once the Fed sees that inflation expectations are back to where they should be, it's quite possible that at that point they say, we don't really need to raise rates anymore because we don't want to hurt the economy unnecessarily. So nobody really knows for sure. A lot of it is tied not just into the supply and demand at the moment, but also at the forward expectation of inflation, which again, as of May 10th, is about 2.1%, which is fundamentally where the Fed's target is.
Well, listen, you went back as far as 1970, and the reality of it all, what we talk about and what we've always discussed openly, you and I, is that the better metric than guessing where we're going is using history as a guide. So that's what we do. That's what you guys do, and we always teach that and preach that to our clients. History as a guide, much better than trying to guess where we're going.
Absolutely. And Greg, it's all of this is based on data and evidence. So whether it's the Fed, Dimensional, you at Prado, it's all about looking at data and evidence. It's not what we think, it's just what does the data suggest. And I think that in this way, Fed, Dimensional, Prado, we're all aligned that data is incredibly valuable in making decisions.
Excellent.